Welcome back to the channel, everyone. Today, we're diving deep into a topic that's central to the financial decisions many of you face: investing in stocks versus bonds. As a financial expert, my aim is to provide you with a nuanced analysis of both options so you can reflect and make informed choices based on your unique circumstances and goals. Let's start with liquidity. Stocks are generally considered more liquid than bonds. This means you can buy and sell stocks quickly during market hours without much hassle. The stock market operates on a continuous basis, allowing investors to access their funds almost instantly. This is particularly advantageous for those who might need to react to market changes or unexpected personal financial needs. On the other hand, while bonds can also be sold before maturity, they often come with greater restrictions, such as being tied to specific maturity dates or having lower trading volumes. For example, government bonds might be relatively easy to sell, but corporate bonds can be more cumbersome due to less active secondary markets. Next, let's consider accessibility. Today's technology has made both stocks and bonds accessible to a broader audience than ever before. With just a smartphone and an internet connection, you can buy shares of major companies or even invest in fractional shares. However, bond investing might require a bit more understanding of specific terms and conditions, particularly if you're looking at municipal or corporate bonds. Some bonds have minimum investment requirements that might not be as appealing for small investors compared to fractional shares of stocks. Therefore, if you're just starting out or working with limited capital, stocks may present a more approachable entry point into the investment world. Now, profitability is a significant factor when comparing these two options. Historically, stocks have yielded higher returns over the long term compared to bonds. The stock market has averaged about 7% to 10% annual returns after inflation over the last century. However, this comes with higher volatility. Stock prices can swing dramatically in short periods due to market sentiment or economic events. Conversely, bonds typically offer lower returns, often in the range of 2% to 5%. But they provide more stable income through interest payments and are generally less susceptible to dramatic price fluctuations. This stability makes them attractive for risk-averse investors or those nearing retirement who prioritize capital preservation. Speaking of risk, it's crucial to understand how each option aligns with your personal risk tolerance. Stocks can be exhilarating when they're soaring but daunting during downturns. If you're someone who thrives on excitement and can tolerate uncertainty, then stocks might resonate with you. However, if you prefer predictability and security in your investments, then bonds may be a better fit. It's important to assess not only your financial goals but also how you emotionally handle investment fluctuations. The psychological factors associated with investing cannot be overlooked either. Investing in stocks often invokes emotions ranging from euphoria during bull markets to despair during bear markets. This emotional roller coaster can lead some investors to make impulsive decisions that undermine their long-term strategies. On the other hand, bonds tend to create a sense of calm among investors because of their predictable nature and steady income streams. That said, even bond investors are not immune to anxiety, especially when interest rates rise and bond prices fall. In conclusion, both investing in stocks and bonds present distinct advantages and challenges that cater to different investor profiles and goals. Stocks offer higher potential returns along with greater liquidity but come with increased risk and emotional volatility. Bonds provide stability and predictability, but generally lower returns and potentially less liquidity depending on the type chosen. Ultimately, the choice between stocks and bonds should not be seen as an either-or situation. Rather, it could be beneficial to maintain a diversified portfolio that includes both asset classes tailored to your financial goals and risk tolerance. I'd love to hear from you. What are your thoughts on this comparison? Have you leaned more towards one over the other? Share your experiences in the comments below. Let's engage in this discussion together. And as always, don't forget to like this video and subscribe for more insights into the world of finance.